In today's episode, I'll talk about two interesting stories. In the first story, I'll talk about DMart's latest quarterly results and what they tell us about India's retail economy at large. And in the second story of the day, I'll talk about how exactly India is doing when it comes to being an alternative to China across the entire world. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 14th of January. Recently, DMart released their quarterly results for the third quarter of FY 2025, and because of that, there has been a lot of discussion around how the company has been performing. And the reason why there is so much chatter about it is because DMart is one of the largest value retail chains in India, and it has a market cap of over 2 lakh crore rupees. So as a direct result of DMart's size and scale, it is very important for all of us to understand how DMart is doing to understand India's retail landscape a lot better. Now, when it comes to DMart, people are currently also talking about how its PE ratio, which is price to earnings ratio, is above 80, which some people see as high. But before we dive into the numbers and talk about everything else in detail, let's first clearly understand DMart's business model from ground up. See, DMart is built on the simple insight that Indians love getting good value and they enjoy discounts. Now, this idea has practically shaped their entire approach, which they describe as everyday low cost, everyday low price. Basically, DMart tries to procure products at very competitive prices and then uses very efficient operations and their distribution network in order to pass the savings to customers by offering lower prices than any other retailer. Now, in order to make this work, DMart usually buys in bulk and it pays the supplier much faster than most other competitors do. And by clearing these payments quickly, DMart basically ends up building a lot of trust with the suppliers who can thereon give them better deals. DMart, by the way, also develops and sells many of its own private label products, and this eventually helps them reduce intermediaries and improve their profit margins. Now, another interesting thing is that DMart focuses on owning most of their stores rather than renting them. And this is a very interesting way how they keep their prices down. Look, rent for retail spaces in big cities can be absolutely massive. And by owning these properties themselves, DMart practically is able to shield itself from all these rising rental costs. Now, these stores are also designed to fit a large number of products in very small spaces. And this reduces expenses and also boosts sales at the same time. Now, another important part of DMart's strategy is its cluster-based expansion. See, instead of opening stores in random locations across India, DMart actually focuses on specific regions and grows store by store in these areas. This way, they can manage logistics smoothly, keep distribution costs low, and also build customer loyalty in every single region before they move on to the next one. Now, of course, this may not be rapid expansion like most other startups are looking at today, but it is steady and it definitely reduces the risk of overstretching their resources. Now, one of DMart's standout strengths, which I must point out to you, is how many products it manages to sell per square foot of store space. DMart basically focuses on fast-moving everyday items like groceries and cleaning products, which people like you and I require very regularly. So by stocking high-demand items, DMart essentially is able to make sure that customers keep coming back to them, and this helps improve their sales volumes. And also, since profit on each items are pretty thin, DMart essentially will need to sell huge number of items in quantities in order to remain profitable, and that is exactly what it focuses on doing and also ends up doing pretty well. But the thing is, even with such a successful model, DMart is not quite immune to challenges as you might imagine. See, quick commerce services like Blinkit, Zepto, etc. today have made it very much possible for customers to get groceries delivered very quickly, and today many shoppers are picking convenience over cost. DMart has also responded through its online business DMart Ready for Sure, and that has also been growing at a steady pace. But the thing is, moving online from a company that was purely offline can be sometimes very tricky. Offering home delivery is usually much more expensive than making customers pick up their orders at physical store, and this is pretty much like a delicate balance for a low margin business like DMart and grocery as a whole in general. So with all of this context in place, it's a good time now to understand what the quarterly results are actually saying. See, DMart's revenue for Q3 of FY 2025 grew by about 17.5% year over year, and it reached nearly 15,973 crores. Now, its net profit for the same period was about 724 crores, which was up by around 5% since last year. But while revenue growth looks pretty strong here, the thing is, margins for DMart are under a lot of pressure. The company's net profit margin dropped to 4.53%, which is lower than the 5.09% margin that they had last year, and it is also slightly lower than the 4.57% margin that they had in the previous quarter. Now, the management pointed out that heavy discounting in the FMCG category was one of the main causes in this squeeze on margins. Also, same-store sales growth, which basically measures sales in stores which have been open for more than 2 years, was about 8.3%. Now, that is better than the previous quarter for DMart, but it still shows that there is a very tough environment out there where costs are going up and competition is growing every single day. Now, one big reason why margins took a big hit for DMart is that a higher share of DMart sales now come from low margin items like food and basic household goods rather than from categories like general merchandise and clothing, which usually have higher profit margins. Now, the ongoing discount wars in the FMCG space, especially in metro cities, has made this even worse for DMart. Also, DMart has opened 10 new stores in this quarter, which has brought their total to 387 stores now. Now, of course, new stores need some time to break even and start contributing solidly to the bottom line of the company. So that is another factor that is weighing in on DMart's profitability right now. Now, on the e-commerce front, DMart Ready, which is DMart's e-commerce platform, recorded a 21.5% growth in this financial year. Now, while that number seems pretty good in a manner of speaking, the cost of delivering goods to people's homes is much higher than the cost of selling in store, like I previously mentioned as well. So, as more shoppers demand home delivery instead of cheaper pickup point model, DMart must keep adjusting its strategy in order to meet demand while also keeping a very, very close eye on all of the expenses. DMart mentioned in their earnings report that it sees more and more demand for home delivery now, so they're planning to steer the business accordingly in the future. Also, finally, there is a big change at the top of DMart's management. DMart's longtime CEO is now stepping down after 2 decades at the company. He's succeeded by Anshul Asawa, who is a former Unilever veteran. Now, this leadership change will add one more layer of interest to this great story of how DMart will navigate this shift towards convenience-driven shopping while maintaining its reputation for value and price. So as investors and people who track the markets, DMart is a very, very interesting business to keep an eye on to understand India's consumer landscape as a whole. With that thought, let's move on to the second story of the day and talk about something that suggests a big shift in the way countries do business with each other. Look, for a long time, globalization was like a buzzword. Countries wanted to trade freely, companies moved production wherever it was cheapest, and goods were flowing across borders in larger and larger quantities. Globalization really picked up pace around the 1990s. For example, if you look at the share of exports as compared to the total world economy, exports used to make up about 15% of global GDP in the early 1990s. And today they are close to 25%. That is a massive jump, and it has helped many countries grow their industries by selling products and services overseas. Now, India also joined into this when we introduced our new economic policy in 1991 and we opened up our markets to welcome foreign investors. But around 2008, things started to slow down for us. The world was hit by a financial crisis and then trade wars began brewing. Ordinary people in many countries felt that they had not really benefited from the fast pace of globalization and they started demanding some changes. Governments also started to get nervous about just relying on one trade partner, which by the way was often China, so they began looking for ways to reduce risk. And this slowdown was called globalization. But now in the recent years, a very new trend is starting to emerge. Many people call this as deglobalization. And it's not just COVID-19. Right after that, there was a war in Ukraine, there were growing political tensions across the world, and there is a strong push for cleaner, greener energy, which has made all countries think even harder about depending on overseas suppliers. Now, governments have started to launch policies that focus on building things at home or working with only the most trusted partners that they have. Now, in our country, India, this initiative is called Atmanirbharta. In Europe, it's called strategic autonomy, and in the United States, it's called America First. Now, there are different terms, but the basic idea still remains the same, to be more self-reliant than to depend on the others. Now, one of the reasons India wants to become more self-reliant is energy. See, we are one of the world's largest markets for crude oil and also for solar panels, yet we still have to import most of our energy needs. Another reason is electronic manufacturing, especially semiconductors, which are, by the way, tiny but powerful chips which go into everything from your smartphones to your cars. Now, because these chips are so important, the Indian government has now rolled out programs like the India Semiconductor Mission and SPECS, which is Schemes for Promotion and Manufacturing of Electronic Components and Semiconductors. And as a result of that, India has now become a much bigger electronics producer than it ever was. In fact, the export of electronic products have nearly tripled between the year 2022 and 2024, largely thanks to smartphone production. Now, Apple is a great example of how this is exactly playing out. See, a lot of Apple's devices used to be only made in China, but India is now taking a good chunk of that business. Last year, India was assembling 1 out of every 7 iPhones. But with the launch of iPhone 16, made in India iPhones have started to hit global stores on the exact same day as the ones made in China. Even more advanced models of the iPhone like Pro and Pro Max are now being made in India, which shows that Apple's main manufacturing partner, Foxconn, is getting more comfortable producing high-end devices in our country. Now, naturally, you would assume that China is not quite happy about it. There are reports that China is making it much harder for Foxconn's Chinese staff to come to India, and it is also holding up shipments of specialized manufacturing equipment. Now, these reports are not confirmed by Apple or Foxconn, but the thing is, if they are true, this could slow down India's effort to become a smartphone manufacturing powerhouse. Now, this is very important for us because making things like iPhones is more than just about assembling products together. It involves transferring the technical know-how from experienced Chinese workers to the newer Indian teams. That's how, by the way, China itself had become the factory of the world in the first place. Foreign companies set up production there, but they had to share technology with local workers in order to train them for the future. Now, this problem of relying on technology and experts from overseas is not just India's issue. The United States also faces the exact same challenge. Even though semiconductors were practically invented in America, the US government did not invest enough money to keep chip manufacturing in its own country. As a result of that, countries like Taiwan and South Korea poured much more money into factories, and the US share of global chip manufacturing dropped from 37% in 1990 to just 10% in 2022. But now, in order to turn things around a little bit, the US has passed the CHIPS Act, which offers big incentive to semiconductor companies. Now, one of the biggest chip manufacturers in the world, TSMC, has agreed to invest 65 billion US dollars in order to build 3 factories in the US by the end of the decade. Now, building these factories took a little longer than expected, partly because there weren't enough skilled workers in the US who knew how to set things up. So just like in India, US also ended up relying on experts from Taiwan. So all of this shows that while countries want to move away from globalization and become more independent, they still need foreign partners, at least in the short term. Supply chains have become so interconnected over the years that you cannot just snap your fingers and produce everything on your own straight away. And that is why technology transfers, training, and international partnerships remain and probably will continue to remain very, very important. So if India hopes to follow the path that China took and eventually become self-reliant, we will need foreign companies to share their expertise, at least in our initial stages. But if tensions and trade barriers get into the way, that will make our journey much more harder. Let's now move on to the final section of the day, which is the quick news tidbits. First, Zomato and Swiggy are now in the spotlight because of their private label ventures, Bistro for Zomato and Snack for Swiggy. Now, industry groups like the Federation of Hotel and Restaurants Association of India, which is also FHRAI, and the National Restaurant Association of India, or the NRAI, claim that these services are using data from partner restaurants in order to promote their own products. They are also worried about food safety and unfair competition in this case. Now, this matter could soon reach the Commerce Ministry and also the Competition Commission of India, or the CCI. Second, Coal India is exploring lithium brine assets in Argentina, and they are teaming up with the Indian Rare Earth Limited to acquire critical minerals because it helps Coal India reduce its dependence on fossil fuels. Securing lithium and other essential minerals will give the company a strong foothold in a very fast-growing green economy. Third, the Indian rupee recently fell to a record low of 86 rupees against the US dollar. Now, this drop mainly comes from foreign investors pulling out money and the dollar being particularly stronger than before. Now, a weaker rupee helps exporters because their goods become cheaper overseas, but it also makes imports more and more expensive, which drives inflation and makes everyday life costlier for households. Businesses are now facing larger expenses for buying raw materials from abroad, which is putting added pressure on their bottom lines and on the market sentiment as a whole. Well, that's all the news and stories I have for you today. I hope you enjoyed the episode and maybe learned something new from it. As usual, I will see you in the next episode. This is Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.